everyone, welcome to Accounting 210. In this video, we will talk about Chapter 11, Standard Cost and Variance. How to say this chapter? Personally, I think when you first read the chapter or you first watch the video, you may say, oh, I feel it's a little bit hard, but I would say read the textbook, watch the video first, and then think about this, and then after 2 or 3 days, watch the video again. I believe when you read the book or watch the video for the second time, a lot of things will make more sense. And I think you are lucky because you are open book. Don't worry too much, but worry definitely you need to put your effort, put your time. Okay, so that's my personal feeling with this chapter. It built with the chapter 9, chapter 10, talking about master budget, also talking about the variance. So I hope you still remember those things. Remember when I learned when I taught chapter 10, I said, hey, it's related with the chapter 11. So also go back to chapter 10 if you still have any question. So let's get started. Chapter 9, we use this tortilla company as our example, and then chapter 11, we talk about the variance. So we said that you have actual, right? So we said company have the actual, and then company have the master budget. And then so we said that's not enough. We also have a thing called a flexible budget, right? We also have a flexible budget. We call the difference of actual and flexible budget as a flexible budget variance. The difference of flexible budget and the master budget, we call it volume variance, right? Volume variance. So we talk about the actual. We said everything you can break it down actually to 2 parts. The actual, you can break it down to actual units times the actual price. Master budget, you can break it down to budgeted units times your budgeted price. Flexible budget is in the middle. It's like a hybrid concept. So it's your actual units, but we time the budgeted price. So it takes the actual units but time the budgeted price. Okay, so that's our flexible budget. What we will learn in this chapter, we carry that concept and we break our flexible budget variance. We break our flexible budget variance to 2 parts. We said that that's not detailed enough. We want to break down this flexible budget variance to 2 parts. So that's what we are basically covering today. We break down flexible budget variance to 2 parts. Okay. So before we talk about that, your first learning objective is we talk about something called the standard cost. Standard cost is similar with the master budget. But master budget is for the company overall. Standard cost is for a single unit of product, Basically, think about the word, right? Standard cost, based on the standard, based on the menu, based on the instruction. The standard, everything works perfectly. You know, what's your standard cost? What's your standard raw material? So that's just the standard cost. I'll get some general idea. I think most likely the question will give you this information. I don't think you are required to calculate. So we go through this in order to for the standard cost of direct material, right? To make one case of chips based on standard, everything works well. So the standard material is 5 pounds of flour, and then we are talking about direct material first. Sorry. So talking about the corn flour. For one case, you need 5 pounds, and each pound costs $1.5. So you get $7.5 for one case, direct material. Direct labor is to make one case, you need 0.05 hour, and then 1 hour you pay $22. So you pay, the standard is $1.1. For the variable manufacturing overhead, we first calculate the variable manufacturing overhead rate. It's your total cost divided by the cost base, right? We use the merchant hour, $25 for 1 merchant hour. We totally need 0.1 merchant hour. So it will cost 2.5 for standard of 1 case. And then we also have a fixed manufacturing overhead. We also do the same thing. You get the rate, you time the actual number of machine hour, you get your standard fixed manufacturing overhead per case. So based on the standard, everything works perfectly fine. Our standard cost is $12 for each one. Okay, so now let's really get the meat part for this chapter. Learning objective 2, we started thinking about direct material variance. So in this chapter, we remember our goal is we break down flexible budget variance to 2 parts, right? They have different names. So one part, they have a different name. But you have 4 items to break down. We have to break down direct material, direct labor, variable manufacturing overhead. So those 3 parts, these 3 items, they are very similar because they are all variable cost, right? They are all variable cost. And then we also have this fixed cost. So we totally have to break down these 4 items, the flexible budget variance. And for each one, we will break down that to 2 parts. So in this chapter, we will have 8 variants. Does this make sense? Does this sound scary? Don't worry, your professor is here with you, right? Don't worry too much. So we talk about this concept first, and then we do some practice. You will feel much better. Learning objective 2, compute and evaluate direct material variance. So we talk about the first variable cost, the direct material. This is from your textbook, give you the information. We have a master budget, 29,000, our actual is 31,000. So we only think about flexible budget variance, right? Our goal is we break flexible budget variance to 2 parts. You already got this one from chapter 9, I believe, when we did the master budget. Direct material, we said will be this. This is the actual. Flexible budget, we use the actual amount, right? We use the actual amount. We time the master budget price. But overall, you got all this number, We said the difference will be 8,500. Direct material actually is lower than the flexible budget, so that's a good thing, that's favorable. Direct labor is $775 more than the flexible budget, so that's unfavorable. Variable manufacturing overhead, you thought you will have 85,000, whatever, but sorry, you thought you will have 77,000 something, but actually it's 85,000. So you have 7,700 more, which is unfavorable. So the question is, we look at direct material first, right? We got 8,500 favorable. You want to ask yourself, why is favorable? Why is favorable? Hey, you are the manager. Look at this. Think about this. You are not just calculators, right? I'm not a calculator. I'm a professor. I believe you are not. You are a manager. So when your accountant give you, our accounting major students give you this number. The accountant said, oh, we are 8,500 favorable. What does this number mean to you? You know, oh, it's a good thing, it's favorable. But what causes this favorable? Why direct material? We spend less money. Why? 2 main reasons. Very good point, your textbook. Because you paid less for the material. Because you thought you will pay. The question said, right? You thought you will pay $1.5. Maybe you paid less. You paid 1.3, right? Or we use the less material. You thought you will use what pounds, but you actually only used less pounds. All because of the 2 reasons. So our goal is we break down this big number to 2 parts. Why we bother ourselves, right? Why we don't just watch TV and just enjoy ourselves? Why we have to bother to do this? Because we want to get the story behind the numbers. We want to know why it's favorable. because the price is cheaper, or because we use the less pounds, or because both of them. So we have to break down this big number to 2 parts. Now let's get the number, let's get the number. Okay, so how do we break down those 2 parts? You have this cases produced 31,000 cases, direct material purchased, and then remember, we purchase this pound and our purchase price is 1.4. Raw material we used all of the purchased. So how do we get all the numbers? Okay, similarly, okay, when you get the calculation, you do this. You have actual cost, actual quantity times actual price. The way I do it is most usually I put the initial kind of like A times A, actual times actual. You have a standard cost. You use your standard quantity times your standard cost. So you have a standard times standard. And in the middle, it's always the hybrid. You use your actual quantity, but you time your standard cost. You said this looks familiar. I remember at the very beginning, I talked this actual, budget. Remember? Perfect. You got it. Your left side is always actual. Your right side is always budget. No matter budget or standard cost, the middle is always the hybrid. It always use your actual units, but use your budgeted price. Does this make sense? Actual, standard, actual, standard. Okay. Now let's get all the number. Actual quantity time our actual price. Let's look at how do we get the number. Actual, we purchased the actual quantity we purchased, right? We purchased 160,000 pounds. Okay, so once you put 160,000 there, you can just put 160,000 here directly because they are both actual units. Our actual price is how much? Actual price is $1.4 per pound. Actual price is $1.4 per pound. Okay, our actual price is $1.4 per pound. Now we got actual time actual, and then we have actual time standard. Okay, standard, we said the standard price is how much? Standard 1 pound, our standard is how much? Based on the standard, 1 pound should be $1.5. Based on the standard, 1 pound is $1.5. Remember this? So our standard is 1.5. If you put 1.5 there, you put 1.5 here. Okay, you put 1.5 there, you put 1.5. Do me a favor, you put 160,000 there, you put 160,000 here. Okay, so how about our standard? How about our standard quantity? This is the only thing you need a little bit of calculation. So what is our standard quantity for the direct material? How many pounds based on the standard? Based on the standard, one case we need 5 pounds. We made how many cases? We made 3,100 cases, right? So we produced 31,000 cases. So we produced 31,000 cases. The standard said each case we should have 5 pounds of the flour. We produced 31,000, and then we said each case we need 5 pounds. So how did you get the number? It's from the standard. It's from the menu. Okay, it's from the menu. Does this make sense? That's all. So here is just the little bit extra calculation. This is the main thing for the calculation here. So students, if you have any question, make sure you understand this part. I will say this is the calculation part. And then if you do the number, this is $224,000. This is $240,000. And then this one is 155,000 times 1.5 gives me $232,500. Okay, so now we look at this, right? The difference of this and this, we call it a price variance. We call it a price variance, and it's 16,000 favorable. The difference of 240,000 and 232,500, we call it quantity variance. And it's 7,500 unfavorable. I interpret the number with you next video, but this, you got this, you are good for the calculation. I see you next time, and let's talk about what's the meaning of this favorable and unfavorable. Thank you.